All right, next is chapter 5, which is financial statement analysis. For you guys, some of this is new, but a lot of this is review. And we're going to go through this because, again, it's essential for you to know the lingo and also the refresher on items you're going to use throughout your career, but certainly if you're inside of a small company. So learning objective 1, what are the tools we use for financial analysis? Number 2, what are cash burn rate, build rate, net burn rate, and the related measure of Runway? And third, do you remember your financial analysis and how to use ratios? We're going to do a refresher right now. All right, so tools. We have 4 things that we have looked at: ratios, trend analysis, which usually means over time for an organization, cross-sectional, which is sometimes we call these vertical and horizontal analyses, which has you dissect either a company over time or a number of different companies in the same industry to compare their relative profitability and its cost structure. And fourth, industry comparables, to look at your company versus the industry averages and seeing how you stack up. So first we're going to look at some data. I'll go through this quickly because I want to use the data, not just look at the data. So table 5.1 is the income statement. Table 2 is the balance sheet. Table 3 is the statement of cash flow. And in this case, we see that it's the change in major balance sheet accounts and broken into operating, investing, and financing. That's one I suspect you're less familiar with, or as compared with income statement and balance sheet. All right, so let's do some venture math. So cash burn, build, and burn rate. So let's start with cash burn. This is a measure of how much money you spend for running your business. And in this particular case, we're breaking it into inventory-related expenses, namely how much do you have to spend on inventory, the combination of cost of goods sold and the increase in your inventory levels. In other words, it's not sufficient to just have enough money to pay for your cost of goods sold. If you're growing, you're going to be building your inventory, and that takes cash. However, if you're trimming your inventory, that uses less cash. So that's how it works. So it's a combination of an income statement measure of cost of goods sold and the balance sheet measure of the change in inventory. That's one of the trickier ones of the factors here. Next, we just pull some numbers from the income statement. Administrative expenses, marketing expenses, R&D expenses, interest expenses, whatever expenses that are out of pocket cash you want to capture, because that's what we're doing. We're snagging anything having to do with cash. Next, we look at elements in the balance sheet. So we'll look at changes in prepaid. If you had to spend $100,000 on an insurance policy for the next year and you spent it now, yeah, from an accounting standpoint, you're going to count 1/12 of that per month in your income statement. But the sad part is you have to lay out $100,000 cash now. We capture that from looking at the change in prepaids. When we look at the change in that balance sheet account, it'll show that we're investing in something that will pay off in future time. On the liability side, we have changes in accrued liabilities and payables. If our vendors are nice to us, let us pay them slower, we're reducing our cash burn. If they're very demanding and want cash now, we're going to increase our cash burn. And finally, we're looking at capital investments to build the balance sheet, fixed assets specifically, and taxes. So in the example for MPC, we can look at the numbers that we see before. As I mentioned before, the 425 number, the inventory-related expenditures, represent the cost of goods sold of 380 plus the change in inventory of 45. So that's how 425 is derived. The next ones are straightforward, straight from the income statement of 65,000 for admin, 39,000 for marketing, 27 for R&D. Then we add to it the other aspects of changes in prepaids. There were none. The change in accrued liabilities was 1,000, change in payables was 27. And by that, we mean it's increasing so that we're going to be burning that additional cash. So I'll just show you these numbers on the prior slides. So from the income statement, we see the cost of goods sold, that's for 380, and we saw the administrative, marketing, and R&D. Then on the balance sheet, we saw the changes in the payables and short-term loans. And we see on the statement of cash flows, we're seeing a change in these items, such as your investing activity of increasing your gross equipment. So that's captured here. And we get to the net number of 606 as a burn rate for the period. All right, so the idea of cash burn, we want that lower. So the lower the cash burn, the better. All right, so we looked at cash build, burn. Let's look at cash build. Cash build is how much money you're getting from sales. And it's net sales minus the change in receivables. Specifically, it's minus any increases in receivables. So if we had sales of 575, but our receivables went up by 30,000, we didn't get all 575. We only got 545 in cash. Cash build is equal to net sales minus the increase in receivables. The cash build rate is just looking at what time period. It could be a month, it could be a quarter. Typically, it's something like that, and most typically per month. So the net cash burn equals the cash burn minus the cash build. So in this case, we were burning at a rate of 606. We were building at a rate of 545. So we're burning 61,000. Notice that cash burn is a positive number. So we're presuming that young companies are burning cash. We're spending cash. So the signs may be confusing, but a cash burn, if it's a positive number, means you're burning cash, which is a negative to cash, right? So our presumption is we're burning cash. All right, so when we look at the various aspects for this company, what we want to see is cash build be higher and higher. We want to build a lot of money. We want the build rate to be higher and higher, and we want the burn rate, the net burn rate, to go down, right? So over time, or in this particular lecture, I'll put these arrows so you indicate directionally what we want to do when we're managing the business. So runway is the longer the better. If you're that plane looking to take off, you want a long runway so there's no chance you don't take off. So we measure it very simply by saying, what's your cash on hand, and compare it to your net cash burn per month. So if we had $500,000 in cash and we're burning 500 a month, you divide 500 by 100, which means we have 5 months to go before we run out of cash. So you can see the powerful nature of what Runway indicates is how fast you have to raise money. All right, so remember your ratio analyses. So here we show 5 different types of ratios. Liquidity ratios, which say, do you have money to pay your bills? Activity ratio, which means are you running your business efficiently in terms of your balance sheet and your generation of cash and management of your costs. Third is leverage. Are you using debt or equity to finance your business? Fourth is profitability. Are you making money? Are you making money at the top level? Gross revenues going up, gross profit going up, operating income going up, and net income going up, right? We want to see that happening for a startup, all of them going up. And the fifth, market ratios, to look at how is the market looking at your company. So we'll do a few of these. We won't do all of them, just to remind you of some of the more important ones. So in our liquidity, we have current ratio. We want to look at current assets divided by current liabilities. And when I look at ratios, I always look at some numbers that help our brain process. So let's look at the number 1. 1 represents the numerator equaling the denominator. So in this case, if current ratio is 1, that means the amount of money we have, that's short term, current assets, exactly equals the amount of money we owe within 1 year. So that's typically not good. We want that number higher than 1, typically. So that's how we want to look at it. So the answer is we want that number higher. The higher the better, and hopefully well in excess of 1 or 2, so we can feel comfortable that we have more assets than we need to pay our bills. Next is average collection period in days. So this one we want to look at how well are we doing in managing our collections of receivables. We take the net accounts receivable and you divide it by how many sales we get per day. The net result tells us how many days we have sitting in receivables. And the answer here is we want that number low. The lower the number of days, the better, which means we collect money faster. Next measure is days inventory held, which means how long does it take us to sell our inventory. So this one we take inventory divided by average daily cost of sales. And that gives us a measure how many days it takes us to sell our inventory. So again, we want it down. We want to sell quickly. We don't want a lot of inventory sitting around. We like to be very efficient in how we run that. Next is days comparison for 2 companies. Just to take a pause here. So company A has 5 days this year, 5 days of prior, and 4 days prior. Company B went from 15 to 22 to 23. So let's look at them. A deteriorated, but only slightly, from 4 to 5 to 5. So They're taking a little bit longer to sell their inventory than before, but B's in trouble. It used to take them a long time, 15 days. It took them longer, almost over 3 weeks, year two. This year is worse still. So neither one is particularly impressive. A is better in each year than B, but they've got nothing to brag about because they're deteriorating also. But B's in trouble. If you're sitting that much more inventory than your competitor, you're probably not running your business well. So in this case, again, we want that number down, want it lower. Next, we look at days payable outstanding, and this is how fast you pay your vendors. And this is the ratio accounts payable divided by average daily cost of sales. And so in general, we want this number to be that vendors are generous in giving us time to pay. So this is an example of one that there is no correct answer. If it's very high, but it's only very high because you don't pay your bills, that means you're having a lot of payables outstanding, but it also means that you're going to have a bad credit rating. So this is one where we want to optimize and have the right amount of days payable. So, example, if a company, your vendor, gives you 30 days to pay and you pay in 30 days, you're fine. If the vendor gives you 30 days to pay and you pay in 90 days, that's not fine because they notice things like this and you will either have bad credit ratings or they're going to increase the price to you next time because you're a slow payer. So on the other hand, if you pay in 1 week, you're paying too fast. They're giving you 30. Take the time to pay within their agreement, and that way you can utilize the cash for other purposes, or for nothing else, put it in the bank and earn some interest for the extra days. But don't pay it before 30 days. So this is a measure where there is no absolute answer. We want an answer that is optimized. We want to take care of our vendors and not press them beyond their comfort level so they will continue to do business with us on a favorable basis. All right, we have this notion of a net trade cycle. And this says, how many days does it take you to cycle through, to buy inventory, to sell inventory, to collect money from your customers, then take your money and pay your vendors. So this is what we call the trade cycle or the cash conversion cycle. And we use the measures we just computed in order to calculate the cash conversion cycle. So it's the average collection period for receivables plus the days inventory held minus the days payable outstanding. And the result of those three factors is the cash conversion cycle. And if you were to look at arrows, we want the collection period to go down, collect faster. We want inventory to be down, sell faster. And we want payables to go up, again, subject to not hurting your relationship with the vendors. We want them to give you more time. And how do you do what we just said? If you could say to a vendor that we're in a very cash type business and I know you want us to pay in 30, but can we change our terms so we pay you every 60 days, right? That would be an example of a vendor actively agreeing to a longer number of days instead of you just presuming that they're okay with it or not even presuming, say, tough luck, I don't pay you. It's not a good way to manage your vendors. Next is asset turnover ratio. And this looks at how efficiently we generate sales from our assets. Net sales divided by total assets. In this case, the higher the number, the better, because we want to have more sales for every dollar of assets we have. So higher the better. Next is debt ratio. For every dollar of assets, what percentage of those did we finance through borrowing money? So in this case, if we have a high liability, then this ratio goes up. If we have very little liabilities because we have a lot of capital and we fund the company with equity, it will be low. So this is one where we kind of like it low, but if it's too low, that means we're not taking advantage of leverage that's available. So again, this is when we optimize. But if we have to pick one direction, we want it low because it lowers the risk of a company of being in default on their agreements. So examples again, A versus B. A went from 69.9 to 62, so that's lowering their debt. And B went from 85 to 79, also lowering their debt. But A is lower leverage than B, so it has risk. So better or worse, again, it depends on the industry, but it's clear that A has less debt and therefore has less risk. That is true. So we optimize this based on the industry and what's safe for the company. Times interest earned says, how safely are you in earning money to pay your interest? And again, here's we use 1. If this ratio equals 1, the interest expense exactly equals the operating profit. In other words, all the money you make goes to pay interest. That's not good. So this one we want the TIE to be high because we want to be very safely above what we owe in interest. So the higher the better for TIE. Gross margin, I think you know this one, is gross profit divided by sales. For every dollar of sales you have, how much do you make in gross profit? This one we want high. More gross profit, the better. Operating margin. So out of running your business, for every dollar of sales you have, how much does your operations generate? After paying operating expense, rent, salaries, insurance, depreciation, all those expenses of running the business, are you still making money? And if so, what percent of sales? We want this one high. Next is net profit margin. We go all the way down to net income. How much do you make for every dollar sales? Guess what? We want this one high too. The higher the net margin, the better. Return on total assets. What is the total net earnings for the company divided by assets? So for every dollar of assets you have, how much money do you earn? Guess what? We want that one high. The more you can make for every dollar of assets, the better off you are. Return on equity. For every dollar of equity you have from shareholders, how much money do you make? Do you want to make more or less money for your shareholders? Answer, more. So the higher the return on equity, the better. So directionally, they should make sense to you, and it builds an instinct, as I mentioned in class. We want to have an instinct on how we run the business and what's good and what's bad. Earnings per share, this is a market-based measure, is what are our net earnings compared to the average shares outstanding. So the market loves this measure, so they can gauge us for things like the price-earnings ratio. So we want to have, for every share outstanding, higher and higher net earnings. So the goal is to increase EPS. Leading to what we just mentioned, price-earnings ratio. The numerator is determined by the market. What is the market price for your stock? The denominator is what's your earnings per share, and the net result is the PE ratio. In other words, for every dollar of earnings you have, how much market value does your stock have? Guess what? We want it high. The higher the PE, the more valuable you appear in the eyes of the investors, and they're fighting to bid up the price of your stock to get your amount of earnings. The DuPont system is something you probably have seen, and it is a disaggregation of a big ratio into smaller ratios. And it's good because it shows the interrelationship between ratios. So here is the DuPont formula to get to return on investment. Net income divided by net sales is net profit margin. For every dollar of sales, what is your net income? Next is for every dollar of assets, what is my net sales? So what we're saying is we're looking at two things, is how profitable are you and how efficient are you at running your business. The net result is return on investment. For every dollar of assets you have, how much profit do you make? So that disaggregation shows you, did you make money because you're very profitable, or do you make money because you turn your assets very quickly? Example being a luxury jeweler has very high margins or very low asset turns, and a company like Costco or Safeway has very low margins but very high turnover. So there's different ways to make money for your investors. The next one on the bottom disaggregates further into look at return on equity, looking at is it from ROI, from your profitability per dollar of asset, or is it from leverage? So if we have low return on investment in terms of dollars per asset, but we have a lot of leverage, a lot of debt, we can make money for our investors by using other people's money. So the first measure is a standpoint of your efficiency to make money. The bottom brings in the factor of your leverage to say how profitable are you for your investors. We want everything up. We want high margins, high turnover, leading to high ROI. We want high leverage, again in moderation, that increases our return to our shareholders. The caution, again, is leverage. If we have too much debt, we have risk of bankruptcy, and that's not good, and it puts the company in peril. So that one is in moderation. So summarizing Chapter 5, we have some new, a lot of old review. We have a lot of tools we can use, ratios, trends, cross-sections, and comparables. And in terms of venture finance, we look a lot at cash. So therefore, cash burn, cash build, net cash burn, and runway are all in our language. because we watch cash very carefully. And finally, we have our old friends, the ratios, and we looked at a few of those to refresh us because we're going to use those to measure the health of our company, and we know that whoever's using our financials will be running those ratios. So we might as well do it for them or before they do it so we know the answers to their questions.